Welcome everyone to the Stock Talk for July 8th. I posted a video last week in terms of my thoughts on broad markets, so if you haven't taken a look, check out that video as well. In the meantime, we're going to tackle the SP 500 daily time frame and see if we can see anything different. For the most part, things haven't changed too much, but what we can observe here today is a down day. We have in the past made marginal new highs followed by retracement. So if we get a retracement this time around, the first thing you want to realize is that it's not the end of the world for broad markets. So if we get a retracement, our first support area is and will be around 294.30 to 293.60, which corresponds to a gap fill area and the 20 period moving average, which is curving higher. That is our near term support, but our more longer term support will have to be this basing area. This basing area is around 288 to 287. So if you look at this this area or time point, this area has acted as resistance, this area has acted as support right here, and if we do get a retracement, we'll be going towards the 50 period moving average, and that is a more significant resistance or support than the 20 period. So as you all know, in a bull market, generally speaking, the lower we get, the more of a significant level that we will have to observe. And what that means is, in a bull market, the more lower we get, we'll have more buyers going into the market, and one of the support levels, or the lower support level, is more likely to hold. In a bear market, as we can see, support levels are less likely to hold as we move lower. So you can see from here that support levels are less likely to hold. Even down here, support levels are less likely to hold. Even down here, 254.85, support levels were less likely to hold, resulting in the capitulation bottom. So here, that's what we're looking for. If we get a retracement, which could be likely in the next few days or to weeks, then that's the area of support. Talk about the other side, the slightly less likely scenario in my opinion, but if we get this move, which is a melt-up move towards SPY 320, that is also possible, but a smaller chance. And you're like, well, what does that mean? How do we get a melt up towards SPY 320? Well, as I have pointed out in the past, that this is a bull market, not a bear market. This has been proven many times in terms of how we buy the dip. The dip is what you perceive as good buying opportunities. And what I mean by that is, if you felt that 276.84 was a good buying opportunity in a bull market, you should be able to achieve higher than 276.84. That is that we're looking at an index, the S&P 500, in some point in time in the near future. So even if you got in right here, you made money. Maybe the lower it goes, perhaps you don't know where the low is. The lower it goes, the more you possibly add in, and you would still be positive. So while we were in a quick bear market, the overall trend continues to be bullish, and we're looking at the long-term trend. If we look at the 8-year trend, it's all bullish. So this bull market is more likely to continue than not. The question is, what do you perceive as a retracement? What do you perceive as a retracement to add in? And that's just my opinion. You can take that for what it's worth. But right now, are we elevated? Yes, we are elevated. If you look at these marginal new highs, we're again at the upper 1%, let's say, of so you just got to be careful as we make these new highs. If we get a melt up towards SPY 320 or higher, that will result in a lot of short covering. But you have to be careful, because in a melt up scenario, as quickly as we can move higher, we can drop just as quickly. So after that move would be finished, we would drop, and we will have to recognize where the support levels will be if we get that move. So far, we don't see any signs of that move. We don't see any signs of a major retracement, but pointing out two major pictures that I'm looking at right now. A lot of the bearish case and people who are bearish point towards the monthly time frame for the S&P 500, with regards to this candle here, the May to June candle. So this is the May candle, and this is a candle that overtakes the green candle, right? So in most cases, we have to observe that this would result in a down move. So that is interesting, right? What we can see is we're above that candle while this month is continuously developing. And this is why I want to place a little bit of caution, is that we have alternating candles. If you look at this, this is green, red, green. So we're alternating in candles. So we'd expect this actually to be a red candle if we just look at this. So this is why for people who are a little bit more bearish, I think more bearish short term is okay. But if you're saying that the long term trend is bearish, that would be highly in question, given that we've made higher highs, given that market has consolidated in a pretty nice way in the past year, although we've had these major moves lower. But if you look at this monthly time frame, you can say that, hey, this was actually an okay consolidation pattern for broad markets instead of a major whip to the upside, because you know that if we whip to the upside on a monthly time frame, as we had done here, this can result in a more severe correction in the months that comes after. So that's the S&P 500 on the monthly time frame. Let's look at volatility, but not on the monthly time frame. We'll take a look at the daily time frame for TVIX. So zoom in on TVIX, and what we can see here is TVIX, for what it's worth, continues to get rejected near the 20. The 20 is still elevated. So the 20 period is at 1882. We're at 1632. So there's still possibly a little bit more upside. I think the ultimate resistance will be around, if we can get there, around 2130. So around that area will be the ultimate resistance. If we can get there, if we get that quick fear that piles on, I would look for the 50 period as resistance more than the 20. But if this was just the run of the mill retracement before that next move higher for broad markets, in typical fashion, we would expect a rejection at or near the 20 period moving average, since this continues to push a lower high plus a lower low, showing a downtrend. For crude oil futures, I mentioned how in the past you can see that crude oil made a nice rally higher, but then managed a couple of bear flag patterns. This bear flag pattern is actually noticeable right now. So what you can see here is, here's daily time frame, 1 day, followed by a bearish consolidation pattern. Today we got rejected actually at the resistance again. Despite us initially pushing upwards over $58, we got rejected and got pushed lower. So if this is a bear flag, I want to see the reaction off the 150 period moving average, which is at 5630. If we can't hold 5630, look for the next move lower, and that next move lower will take us quickly, I think, towards the $54 and change mark at that point in time. If something changes, change the analysis. But until then, that's what I see. With natural gas, this is something I mentioned last week as well, is that we get consistently rejected at the 50 period moving average. And this happened actually after market on Sunday. You can see that we hit the 50 period. So what's the 50 period? It is the blue line that's coming across over here. The light blue line that's coming over here is the 20 period moving average. So you can see a quick rejection off the 50 period moving average once again. So is this pattern done? Is natural gas done for? Are we going to see no more upside for natural gas? It's questionable now. We've gotten a rejection at the 50 period. So if we expect the pattern to continue, we actually expect continuation back to the downside for natural gas. But I'm saying that natural gas actually has a better chance this time of actually reaching 2.574. We've maintained a higher low, as you can see. We've maintained a higher high. If we can push this pattern and reverse in the short term, we need to first close over the 50 period moving average, and then I think we'll quickly move towards the 2.571 level, which would not be too surprising as well. Right now, we're seeing rejection, but that's typical since we reached the 50 period, right? But it doesn't have to be the end for natural gas this time around. So we're looking for another push higher currently. For gold futures, I mentioned how gold on the daily time frame can consolidate for a while. We still see the same pattern that we saw last week, and that was consolidation. Now, I said consolidation can come by moving or shifting us towards the 20 period before that next push higher, but it can actually trek for a few weeks. So after this really pronounced move to the upside for gold, we can make a push in the next few days back to the upside, but we can also in a healthy fashion, I think, consolidate to the right for a few weeks before another possible move higher. But again, this chart pattern, by looking at this chart pattern, looks like this wants to continue pushing to the upside, and if it does, we look for a break of the resistance, at least on a daily time frame, of 1428. And with that, thank you everyone for watching this video. Feel free to, again, take a look at the course. If I don't post a stock talk on YouTube, chances are there is a stock talk in greater detail in the course that there's other indicators that I'm watching in terms of where the markets can be heading, as well as commodities. And then you can also post the tickers that you want me to analyze in the description, in the comment box down below, not in the description, but in the comment box. So I'd be happy to take a look at them. Hopefully, last time I took a look at a couple of ones that you guys put out, right? Was it Grubhub, Alibaba, Viva Systems? Maybe there were a couple others. Feel free to post those or any other tickers in the comment section down below. Thanks everyone for watching this video. I'll see everyone very soon for another update. Have a great trading day.